Financial markets generate a chaotic, high-velocity stream of raw data. Every second, algorithms process millions of price updates, attempting to extract a clear directional signal from the noise. To make sense of this turbulence, developers use digital signal processing. But filtering financial data introduces a strict mathematical trade-off. Smoothing out the intraday noise requires averaging historical data points, which creates a temporal delay. When you rely on simple statistical tools, like the simple moving average, you process all of those historical data points with equal mathematical weight. The formula values a price from 20 days ago exactly as much as the price from 10 seconds ago. Watch what happens when the market reverses. The moving average takes several periods to register. If we bracket the distance between the real-time pivot and the moment the indicator finally registers a crossover, we expose the gap. That gap is latency. In quantitative trading, latency is the enemy of execution accuracy. For institutional algorithms, waiting for a lagging indicator means entering a trade late. That structural delay guarantees slipped entries, costs valuable basis points, and degrades the overall modeling. In 1994, a researcher named Patrick Molloy published a mathematical workaround. He developed the double exponential moving average, a specific algebraic formula engineered to neutralize this exact latency. Superior quantitative models require minimizing the time between a price event and its measurement. By dissecting Molloy's math, we can see exactly how to close the gap between when a trend occurs and when our systems register it. To understand Molloy's solution, we have to start with the baseline component he attempted to fix, the standard exponential moving average. The standard EMA improves upon the simple moving average by applying a smoothing factor. It assigns exponentially decreasing weights to older data, forcing the math to prioritize recent price action. Yet, a structural problem remains. Even with the exponential weighting, the calculation still relies on historical inputs. It reacts faster, but it still carries an inherent lag factor that keeps it separated from real-time price. Molloy realized he could isolate and remove that lag. His solution is mapped in this equation. The DEMA equals 2 times the EMA minus the EMA of the EMA. Retail traders often assume the double exponential moving average simply applies a smoothing function twice. It does not. Applying a moving average to another moving average would actually increase the delay. Molloy performed a specific trick. By calculating an EMA of the original EMA, he created a variable that represented the delay itself. He isolated the lag factor into an independent mathematical entity. The logic of the final subtraction is direct. You take the base EMA and double its value. Then you subtract that isolated lag variable. The resulting output mathematically pulls the signal forward in time. Let's run a 5-period calculation on Apple stock to see how this algebra executes on real market data. On a 5-day AAPL feed, day 6's base EMA yields $152.46. Step 1, multiply this by 2, giving $304.92. Step 2, apply a second exponential smoothing layer, generating the lag variable. Finally, subtracting this delay yields a DMA perfectly tracking real-time price. This algebraic deduction shifts moving averages from lagging historical records into real-time momentum trackers. This responsiveness solves the latency problem, but it introduces a specific vulnerability into the system. When markets lose their directional bias and begin trading sideways, DMA's proximity to the price action becomes a liability. Because the indicator hugs the price, rapid, non-trending fluctuations cause the DMA line to cross the price repeatedly. This produces a sequence of rapid-fire false signals, a phenomenon known as whipsawing. To solve this, research published in the IOSR Journal of Mathematics details a method to insulate DEMA from range-bound noise. The strategy requires pairing the trend line with the Commodity Channel Index, or CCI. This is an oscillator that measures how far the current price has deviated from its statistical mean. The CCI has its own programmatic flaw. It is an unbounded oscillator. During a strong, prolonged trend, the math gets pinned at extreme highs or lows, frequently triggering false overbought or oversold alerts. This is how algorithmic robustness is engineered. Designers deliberately pair contradictory indicators. DEMA fails in flat markets, while CCI fails in trending markets. Stacked together, their math cancels out each other's blind spots. This diagram from the research maps the overarching market structure the hybrid system targets, Elliott waves. Notice the 5-wave impulsive sequence driving the primary trend, followed by a 3-wave corrective sequence that pulls against it. The two indicators divide the labor of mapping this complex structure. DEMA dictates the macro-structural trend, while the CCI operates purely as a micro-trigger for execution. In this Reliance Industries chart, the upper panel tracks the DEMA trend, while the lower tracks the CCI timeline. A valid buy execution requires vertical alignment. The DEMA must indicate a localized downtrend, while the CCI simultaneously punches below the -100 threshold. By identifying where these two conditions overlap, we can mathematically pinpoint the likely exhaustion of an ABC corrective wave. Pinpointing this exhaustion allows the algorithm to enter, just as the primary impulsive wave is mathematically primed to resume. Algorithmic robustness is reached by utilizing a trend indicator to dictate macro context and an oscillator to execute micro-timing. We can measure the efficacy of this hybrid stack by backtesting it across divergent market environments. First, we apply the DEMA stack to high volatility, high momentum environments, specifically major cryptocurrencies, where trend velocity is aggressive. Look at this dashboard plotting standard moving averages against DEMA. During a violent swing, DEMA reacts instantly, capturing the momentum shift while traditional formulas lag. In volatile conditions, it hugs the price action, functioning as dynamic support and resistance. We contrast this high momentum success with DEMA's failure rates in low volatility, flat equity markets. Deploying DEMA against a range-bound equity without an oscillator filter guarantees capital degradation. Its proximity to price generates a continuous stream of false entries. This proves the necessity of the hybrid stack. The CCI is a required technical component because its mathematical properties mute DEMA's output the moment market volatility drops. The core systemic rule is clear. Indicator selection must be dynamically and mathematically matched to the underlying volatility profile of the asset being traded. Zooming out from the DEMA formula gives us a broader view of the philosophy behind quantitative system design. Moving averages, regardless of their mathematical complexity, are not predictive crystal balls. They are mathematical filters processing historical data. Because of this, they always contain structural assumptions and structural blind spots. Deeply understanding the algebraic derivation of an indicator, like how Malloy isolated the EMA lag factor, is the only way to expose those blind spots so you can design around them. Amateur traders often search for a single, perfect indicator that works cleanly across all market conditions. Advanced quantitative developers know that such a tool does not exist. Instead, they deliberately pair contradictory tools, engineering systemic resilience through opposing mathematical logic. The ultimate alpha in algorithmic trading is found by ruthlessly engineering out the structural flaws of the formulas we already possess.